G'day folks, welcome back to another update for high-grade copper and US crude oil. Now they've both dropped quite substantially in the last previous few days, but it's actually been consolidating more recently. I'll go into that in a minute. Don't forget to hit that like and subscribe button to support the channel. Also, don't forget we're looking at a new video series on a weekly basis called Pete's Investing Plus One, where we look at a dumbed down version of our strategies and give you a better insight into our analysis and help you follow our daily videos. So if you're new to trading or an experienced trader would like to fine tune your knowledge, then this Plus One video series will help you gain confidence. Last week's video was about the chart setup, and this week we'll be doing another video again, so just stay tuned for that. In terms of the fundamentals for US crude, prices have declined over 16% since January, with the WTI trading near $60 per barrel. This downturn is driven by reduced global demand forecasts, escalating US-China trade tensions and rising in inventories. The EIA has lowered its 2025 global oil demand growth projection to 900,000 barrels per day, down from 1.2 million. For high-grade copper, prices have risen approximately 6% year-to-date, supported by ongoing demand from green energy initiatives and a mild recovery in China's physical market. However, recent declines such as a 4.92% drop to $4.1690 per pound reflect short-term volatility amid global economic uncertainties. So what we look at first is high-grade copper on the long-term trends. On the monthly, the price is still bullish above the moving averages, although notice the CCI has now hit that moving average range on the CCI. And plus we had this, I would call that a slight bearish divergence, almost a double top on the CCI, even though it's slightly higher versus a higher highs on the price. And even if you drew it based on that and drew a Fibonacci to that low there, you can see there it's already broken down below that 38% retrace level. It's actually broke down near the 61% on that candle, on that wick, and it's finally resting between the 38 and the 50%. So that's still a bearish divergence that's worked out. On the weekly, no divergence, but notice the CCI and the price have broken below the moving averages, although the price has retraced back into that moving average range, but still somewhat bearish to neutral weekly. On the daily, however, that was a strong break below in our last video, and since then it's been consolidating. Now, if you were trading this, the CCI has already broken below that moving average at that point, but ideally you want to wait for the price to also retrace because that could have easily bounced out of that. So I like to see that price also break below the moving averages, so you would have got in on that candle or even that one. And what we look then for. So looking at the intraday first off, you can see here we would have taken short trades only and be close to closing off your trades at the moment because that moving average is being penetrated by the CCI, and that's where you would have stopped taking short trades. But you can see here as well, it's not quite a bullish divergence. I'm going to mark it, but it's not quite a bullish divergence. I want to stay close to the rules. That high is still slightly higher than that previous high. So even though the CCI is rising, I'm not going to call that a bullish divergence. So just a small little lesson there. Now if we go to the back tests, I'll start at the back test, as I said, between that candle there, where it's just about to break below the moving averages, or even that one there. So it doesn't really matter where. The CCI is already broken below, and that's where these two back tests start. The top one here is a stop loss approach, and this one's the average down approach. And just to emphasize, be very careful. Do not trade the average down approach unless you're very experienced and you've got the appropriate bank account, trading account. The stop loss approach is probably safer. But had you stayed in the trade with short positions according to this strategy on the stop loss approach, that would have generated about $1,800, and the average down approach generated $4,800 or $4,900 as we speak. So again, avoid this unless you're very experienced and understand the potential of the risks involved. So this is a US crude oil long-term charts. On the monthly, it's very strongly below the moving average of the price chart, and also the CCI is broken down, so only short trades to be taken. On the weekly, likewise short positioning, both the CCI and the moving averages of the price are below their moving averages. And the daily also is broken down quite strongly in our last video, but since then it's been consolidating in this range. We've got a big bullish candle there, a big engulfing candle, but we don't look at chart candle patterns so much. It's more the trends we look at. And here we can see there it's predominantly still in a short positioning, with the CCI also still dropping away from that moving average on the daily. If you go to the intraday chart, again taking short trades only, we do have a bullish divergence here. Now we had one back here, we drew it previously, and you could argue that was just touched the moving average range. It depends where you drew the Fibonacci, and I would have taken it back to that previous high. You can see there it hit the 23.38% in just within that range, and then it dropped off. But even if you took it back to that high up there, that actually just touched that 23%. But what we're looking at now, we're going to extend that. Had you been following this, and I'm not suggesting you trade this with a long position, we look at this potentially, just be wary of reversal. And this is what it's happened so far. That price kept dropping until that point there, and the CCI kept rising to the same point there. So higher lows on the CCI versus lower lows on the price. And what this has done in terms of a Fibonacci retrace, we'll take it back to that level. You can see there it's broken just above the 38%. So that's a minimum retrace at the 23, and that's already hit that level there. So we just mark it there. So it's already hit that 38% range. Now, this could actually continue to drop. You can see there the daily is still dropping, and the CCI is also starting to fall off again. So very likely it's going to fall further to the downside. Although there's no guarantee, it could also just keep bouncing up from there. And if that happens, we'll reconfigure it, and then obviously you'll stop all your short trades if it hits the moving average range on the daily. So if we look at the back tests, again, I've started the back test here from the point there where that candle broke below the moving average on the price, and that also broke below the CCI moving average. The stop loss approach, you'd still be in a trade today, has generated so far, I think, about 6,400, and it's still live. And the average down approach is 2,300, only because you're in a bit of a drawdown at the moment. And again, I emphasize, do not do the average down approach unless you really understand the strategy and you've got the appropriate trading account balance. You can see there that's actually fallen off below your baseline of 100,000. If your baseline was 100, it could be 10, whatever it is. This one's worked out a lot better in this case. But back here, for example, if you had started noticing a bullish move on the CCI versus the price, that's where you would use the divergence, a bullish divergence in this case. You would have probably stopped taking trades at that point just to be safe. And at that point, the stop loss approach has generated 6,900, and the average down approach has generated, 9,866. So again, always pay attention to these divergence. I'm just showing you here the complete range so far. And if that touches that moving average and this stays low there, that average down approach would have not worked as well as the stop loss approach. Again, look out for Pete's Investing Plus One videos to help navigate chart analysis and improve your profits. Thanks for watching, and to talk to you in our next video.